Thank you very much, Harry, and thank you again for Coaltrans for inviting us to speak here. It's always a pleasure to be here at this conference in Europe, and in particular in Barcelona. I just took out, it looks like there is something between Coal and Barcelona. I just took out a few extracts of a presentation I made 2 years ago when Coaltrans was in Barcelona, not at this hotel. And in fact, already there, I made a comparison with the previous Coaltrans, which took place a very, very long time ago, in 2004, for those of you who were already in the coal market, in the same Barcelona. And each time, and in particular the last, in 2015, we were coming out, or we were still in a quite a bearish market for coal. But as we have seen since, things have turned around quite strongly. And I just put here a few conclusions of our presentation 2 years ago. Whereas we thought that in those days, China was very bearish. But we thought that most of the bearish news were already in the price regarding China. We were expecting a slight increase in monthly imports in the coming month. India and Europe were rather quiet until the end of the year. We still saw a continuous adjustment between supply export side to help to rebalance the market. So in those days, we were starting to see heavy cuts in coal supply. So basically, we thought that this environment of low prices was not sustainable. And we expected still a seaborne surplus in 2015, but then to move into deficit in 2016 and after that. So, and we were relatively bullish prices, or at least expected a support in prices. And what happened since? Well, we all know by now. To put things in perspective, if you can see here, so this was Barcelona 2 years ago, and this is what happened since then. In the big scheme of things, we are still far away from the previous peak, which took place in 2010, 2011, and not to mention the one of 2008 at above $200 a ton. So yes, we have turned into a bullish environment, but taking into account the large perspective, we are more or less, we are not even at the mean price over the last 18 years. So where are we now? Initially, the title of the presentation was China Theory, the Theory and Reality of Coal, but we can, I think, even extrapolate that to the rest of the world. Nevertheless, even in China today, there is an announced willingness to get away from coal, or at least to decrease, as we saw this morning, Carlos mentioned some numbers, to decrease the share of coal in primary energy supply and the electricity mix. There has been the permanent closure of some power plants in cities such as Beijing. Construction of new coal power plants has been stopped from 2022 onwards. And there is already now a push for alternative electric sources, in particular renewables. There is a strong push for nuclear, which we expect to increase by 375 terawatt hours by 2020. A push for hydro generation, which we expect to increase above 1,200 terawatt hour by 2020, and also wind generation. So it is happening. The diversification of the electricity mix in China is happening as we speak. Meanwhile, there is also the structural willingness in China to cut, or at least stabilize and then cut at a later stage, the domestic crude coal production and to cap it at 4 billion tons. But the reality is still different because if you follow the numbers, China broke all kinds of records this summer in terms of total generation, which for the first time breached the 600 terawatt hour in a month in August, or in July, sorry. Meanwhile, coal followed, and that's, again, Rodrigo mentioned that this morning, but we see that very clearly at the moment, that when there is a spike in total generation, we see an immediate impact on coal generation. So we had a breach of record breach in thermal generation as well, at 433 terawatt-hour in July. But the interesting thing is that it was not coal cannibalizing other sources, because meanwhile we had also record electricity generation from nuclear and hydro, for instance. So it was more the total demand that was just enormous in quantity and in percentage, 7% growth, given the leverage of the numbers in China, that fueled the coal demand, if I might say so. We had a strong industrial demand, and on the top of that, there was the heat wave, the hot summer that fueled further demand for air conditioning, and you can see the growth in air conditioning units production in China in the chart below. And on the top of that, we are starting to see households' consumptions increasing fast in China as the country is modernizing, growth of close to 6% year on year in households' consumption during July 2017 compared to the previous year. As a result, thermal generation, mainly coal generation, increased by 7.7% during July, even higher than the total growth. So the share of coal in total has actually stabilized so far this year. We just had the September numbers, which were a bit lower in terms of percentage. But nevertheless, if you take the picture for the year to date, the share of coal has stabilized and even increased slightly. So it looks like China wants to get away from coal, but it's taking much more time than anticipated due to the strong demand. The coal-fired capacity was at 899 gigawatt by December 2016. We expect a relatively modest increase in coal-fired capacity because there are some power plants that have been already ordered and partially financed so far, so they will be built until 2022. So growth to 930 gigawatt by 2020. But as China is modernizing, the capacity utilization at Chinese coal power plant has decreased and is oscillating between 50 and 55%. So from that perspective, there is still a huge reservoir of coal usage at the existing capacity in China, even if China were not to build any new coal power plant after 2022, which is a big question mark. We think it's more a pause for breath in a very high growth scenario, but that actually some new coal-fired capacity will come online after 2022. But nevertheless, given the existing capacity, the coal usage in China could increase massively and rapidly if needed. We have seen a cascading effect on imports. I'm not going to go into the back and forth scenarios of the NDRCs over the last 18 months or so with the switch between the 276 days to 330 days. The net result is that to the opposite of the long-term goal, which is to decrease the crude coal production, we have actually seen an increase in crude coal production so far this year in China by 5.7%. But if you remember the previous slide, it's less than the 7.7% increase in thermal generation we have seen during the same period, meaning that coal stocks, which were already low, have remained at, in fact, historically low level in China over the period, and that imports have been increasing. We keep revising upwards our import forecast for China for this year. China imported 189 million tons of steam coal last year. We now forecast them at 199 million tons for this year, but actually it's quite likely they will breach the 200 million ton mark. So the medium-term outlook is positive for China with the increase in consumption of the service area. By the way, there was a question this morning about the potential switch from Chinese economy from industry to the tertiary sector. In fact, it's not necessarily all bad news. I was at a conference in Norway a few weeks ago, and they are seeing what they call data center being implemented in some countries, such as Google or Amazon of this world, who are implementing large data centers. And in fact, these data centers are requiring a lot of electricity. So I'm not saying that a data center is replacing a steel mill, but it's not necessarily because you move into a service industry that you don't need electricity. And given the level or the low level still today of electrification and electricity usage per capita in China and in other countries, there is still a huge demand growth for electricity consumption in this sector beside the industrial sector. And in fact, we don't think that the industrial sector is dead, quite far from it. Steel production reached a new record in China last summer as well, at 74 million tons. We are seeing the closure of inefficient and expensive coal mines, which is capping the domestic coal supply. And once we shut down these coal mines, the miners are employed in other sectors, such as the automotive sector, for instance, as was the case in Europe 20, 30 years ago. So there is no way back once a coal mine has been shut. So we expect supported domestic prices in China and also supported imports in a broad range, 150 to 200 million ton until 2020 at least. So we don't expect a collapse in Chinese imports to the 100 million tons or less, just because China needs electricity and China needs coal basically to produce this electricity. Now, taking a bit of a long-term perspective, it is, or it could be a bit scary. There is this One Belt, One Road project, or not project, I mean, it's going as we speak, or it is implemented as we speak, a project in China, which is basically, the idea is to link 15 mega cities in China with 15 cities in Europe. Investments of ports and railways. So it's either there will be a maritime way and also a railway through all the countries between basically China and Europe. Total investment of $2.8 billion and priority given to the Chinese companies for this project. So we are a bit scared because in our reports over the last few years, we have been often speaking about the ghost cities being built in China and the roads to nowhere or the motorways to nowhere being built in China, and you have seen some movies about that. And we thought that maybe at some stage China will stop and pause for breath and start to use this spared capacity that has been built. But in fact, it looks like they are pushing forward, and now that they have built so many ghost cities in the country, they are expanding or externalizing this strategy in a way outside the country. And in the short to medium term, meaning 5 years maybe, it's quite bullish iron ore, coking coal, steam coal, because there is a lot of steel that is going and cement that is going to be needed to build this project. By the way, if you look at Pakistan, for instance, most of the coal-fired power plants that have been built recently in Pakistan are somehow linked to this project. So it is already having a big impact worldwide, not only in China, on all these hard commodities, let's say. But then the question is, what's next? Well, first, how are they going to utilize these transportation capacity over the next 10 years? Is there really a need for it and for of this magnitude? And second, once the railways have been built, what comes next to support the domestic steel and cement industry? So we have increasingly some big question marks on China, and maybe the next economic crisis might come from China. It's not today, it's not tomorrow, but maybe at some stage. This is something we are watching closely. Closer to us, China is not the only country struggling to get away from coal at the moment. Just to name a few examples, we saw the same thing happening in Taiwan recently. There were 5 hours blackout that paralyzed the country in August. Indirect consequence of the decision by the government to phase out nuclear. As we saw this morning, nuclear is the second or the first big enemy after coal worldwide in terms of electricity generation. But nuclear still accounted for 14% of the electricity generation in Taiwan in 2016. And quite logically, we saw a drop by 44% in nuclear generation so far this year, which was partially offset by a rise in coal-fired generation of 13.5%. South Korea, a bit of a similar scenario. Again, nuclear generation being hit by the earthquake this time last year, which then triggered a series of inspections at nuclear power plants. Some of them have been shut, some of them have been idle for a while. In any case, the nuclear generation has been falling by 9.4% during the first half of the year, whereas coal-fired generation has been increasing by more than 3%. On the top of that, we had the heat waves over the summer, which fueled the power consumption. So if we aggregate everything, we see an increase, quite a sharp increase in imports, seaborne steam coal imports in 2017 compared to 2016, up by 3.5% in Japan, 7.5% in South Korea, almost 8% in Taiwan, Pakistan up almost 50%, and Philippines up 31%, just to name a few. We are also closer to us in Europe. We are seeing some exporting countries, such as Poland or Ukraine, turning as importing countries, partially, because of the shutdown of coal mines, and also the sharp decrease in coal stocks, which has taken place over the last 3 years or so. So we forecast the steam coal seaborne imports to increase by 30 million tonnes in 2017 compared to 2016. And against that, well, we see a much more modest growth in exports, in production and exports, at 20 million tonnes, to summarize, meaning that the stocks are going down and the supply demand is tightening, according to us. We saw South African exports relatively flat in 2017, Australian export as well, increasing by just 2 million tonnes, Colombian exports increasing by 4 million tonnes, even if there is a big question mark on that. The strongest growth should come from Russia and Indonesia. Now, the question talking about Indonesia, is coal becoming a scarce commodity? The answer is probably yes. And this is an extract of the report on the long-term price forecast with a special section on Indonesia that we are going to launch next month. But basically, the summary is that we are seeing a combination of increase in domestic demand in Indonesia, for instance, because the country is just in this growth phase where it needs more electricity. And meanwhile, we see the combination of a lower quality and difficulties to find financing in mining in Indonesia, for instance, as is the case in most countries. So at the moment, what we are seeing is that we are seeing a few mines being reopened in Indonesia, for instance, the one that had been shut in 2015. But or if there is any spare capacity at some mines, we are seeing these capacity being used as much as possible. What we are not seeing is a massive investment in greenfield projects for coal mining. Australia, for instance, in terms of coal consumption and electricity consumption, they have apparently scrapped their plan of clean energy plan for more of a sustainable energy plan, because even the coal exporting and producing countries seem to realize that given the growth they expect in electricity demand, some of the domestic coal will be required to sustain this growth. In addition, we are seeing a worldwide a decline in coal quality. This was a previous report we published in April with a section on South Africa. One of the findings was that today, or last year, let's say, only 15% of the steam coal exported from South Africa matched the so-called SCOTA specs, or the specs for the API4 index. For those of you who are involved into the financial market, on the hedging or trading side, there's a big debate going on at the moment. I'm not going to go too much into that, but basically the idea or the story is that today most of the indices are produced based on a declining quantity of physical coal to produce the indices, basically, and the qualifying deals. The number of qualifying deals is decreasing sharply. And this is a trend we are seeing everywhere. We are seeing that in South Africa, we are seeing that in Indonesia, in Colombia as well, and in Australia. Another thing, it will be developed more, to much more extent tomorrow, but the freights, on the freight side, after 5 years of bearish trend in freight, we are also seeing, this is something we mentioned last year, this time last year at Coaltrans, that we were getting increasingly bullish on freight and we were seeing some recovery in prices. We are not envisaging anything close to the rally of 2007 and 8, but also because of a lack of investment, a bit of a similar story, and still robust demand in iron ore, steam coal, and what we call minor bulks demand over the next few years, we envisage a much higher freight prices in the coming years, in particular for the smaller size, so Panamax and below. Not so much the Cape size. A few words about Germany. Again, as for China, we saw that the renewable story is happening, and it is occurring in Germany as well, because if you look year to date, in fact, for the first time, wind generation alone will be more or less equivalent to coal-fired generation alone in Germany. So when the capacity is there, when the investment has been made, then definitely yes, there is a cannibalization from coal to or by other sources of energy. The question is Germany a benchmark that many countries can follow, or will Germany remain an exception, at least in the foreseeable future, because of the of the amount of financing that has been required to get there? A few more words about Germany. Nuclear capacity will be definitely shut down by 2022. That was confirmed this morning by our panelists. Nevertheless, it's still nuclear generation still accounted for close to 15% of total generation last year. The last hard coal mines are going to be shut down in 2018, and they still produce 3.8 million tons of coal last year. And again, as confirmed this morning to some extent, and this would be our views, we expect whatever the new coalition will be in Germany, we expect some lignite power plant being shut before hard coal-fired power plants within the next 5 years or so. And it's very unlikely that any new coal power plant will be built in Germany and Europe, maybe ever, unless there is a significant technological breakthrough. So we are saying basically that within the next 3 to 5 years, at least 15%, and most likely between 20 and 30% of the base load in Germany is going to be shut and needs to be replaced by wind, solar, gas, and hard coal. And even if we say that, and we think it's difficult in these circumstances to, at least for the next 5 years, let's say, to be very bearish hard coal generation in Germany. I know we saw some presentation this morning from Trevor. There is some regulation coming in, but this regulation, still needs to be implemented, and the timing can potentially also be delayed. But we just can't see how Germany could cope with a fall of 15 to 20% of its baseload generation. In particular, as we are seeing some industrial growth coming back in Germany and in other countries in Northern Europe. And on the top of that, we are seeing some generation being shut in France on the nuclear side, in Italy and Spain on the hard coal side, and the Netherlands. So it looks like Europe is really cutting hard on hard coal generation, meaning that we think that based on the fact that the capacity utilization at the German plant is still running at about 50-55%, a bit in a similar scenario as what we see in China, there is a non-negligible buffer for additional coal usage if and when required, meaning either a hard winter, a problem with the nuclear generation in France, or whatever happens, with just the existing coal plants in Germany. But in any case, this will mean also a much more volatile hard coal generation or utilization in Germany, and also imports. Now, there are some bearish elements, and the main one is probably the cost of production. This is an extract of our cost curve of production for, let's say, South Africa. We are currently trading, if you look at the top 6 exporting countries, between 20 and 80% above the cost or average estimate cost curve of production in these countries. So from that perspective, there is a huge or a significant downside potential. Now, the thing is that in normal circumstances, these kind of cost curve and the spot prices we are at the moment would attract more investment or new investment in mining. But as Howard mentioned and explained and detailed this morning, we think, and we tend to agree on that point, we think this time is different. Because the bull cycle and the bull run we are on at the moment will not trigger massive investment or any investment in coal mining. This is mainly the consequence of the war on coal that has been going on for years. We really don't see any appetite at the moment and in the foreseeable future for investment into new mines. I think we might have, yeah, okay. So just as a conclusion, we forecast a structural deficit between exports and imports of between 5 and 30 million tonnes per year over the next five years. The current high prices are not generating a significant additional investment in mining, in particular in greenfield mines, which might be required at some stage to balance the books and provide an equilibrium to prices. Meanwhile, we expect flat to slightly higher demand worldwide for steam coal, including China. But we think this bullish cycle is very different from the previous one, or the last one we had in 2010 and 11. In some ways, this Q4 scenario might be relatively similar to what we saw last year, because most of the bullish elements that were here last year are still here today. You know, the French nuclear generation, the issues in China, and the lack of investment in mining. These are becoming structural issues now in the electricity mix, let's say. Now, the thing is that spot coal prices are relatively high today, between the 90 and 100 range. And it's obviously more difficult to be bullish prices at this kind of level compared to the $50 or $60 a ton we were at a few months ago. So even if we are in a bullish environment as far as the supply demand is concerned, we still think that the market is exposed to a potentially severe correction, meaning $10 to $15 on spot prices, which could take place maybe not within the coming weeks, but maybe at the latest during the first half of next year. And it's after this bullish correction, or this bearish correction, sorry, that we would be more comfortable giving a bullish forecast for spot prices. But nevertheless, if we look at the back end of the curve, if you look at 2018, 2019, we remain, we think, in a bullish environment for that sector. So we would expect some additional gains to take place, but again, they might take place once the spot correction has taken place. I think that a few things are missing here, but basically in terms of spot prices, we expect spot prices to remain in the range $80 to $100 FOB for Richards Bay and Newcastle for this year and the first half of next year. And potentially the Cal 18 and even more so the Cal 19 contract to gradually close the gap with spot prices given our structural shortage we expect between supply and demand over the period. And I think that will be it for today. Thank you very much.